Have you ever seen a stock price suddenly surge or a company mysteriously disappear from the exchange? These aren't random events. They're often the result of powerful corporate actions that can dramatically reshape a company's future and, crucially, your investment portfolio. Understanding these moves is key to becoming a smarter, more informed investor. Every major company decision has ripple effects, especially those involving its shares. Today, we're diving deep into three critical corporate actions: share buybacks, delisting, and share swaps. Our purpose is to equip you with the knowledge to anticipate market shifts, evaluate investment opportunities, and protect your capital. By the end, you'll see how these strategies are not just corporate jargon, but vital signals for your investment journey. First up, let's unravel the mystery of the share buyback. Imagine a company deciding to purchase its own shares directly from the open market. Why would they do this? Often it's because management believes their stock is undervalued, signaling strong confidence in the company's future prospects. When a company buys back its shares, it reduces the total number of outstanding shares. This has a powerful effect. The company's total profit is now divided among fewer shares, automatically increasing the earnings per share, EPS. This makes the company appear more profitable on a per share basis, often leading to a higher stock price. It also improves other financial metrics like return on equity, ROE, and can even prevent hostile takeovers. Infosys, for instance, has strategically used buybacks over the years to return excess cash to shareholders and enhance their overall value. Next, consider delisting, the removal of a company's shares from a stock exchange. This can be a significant event for investors, impacting liquidity and exit options. There are two main types: voluntary and compulsory. Voluntary delisting occurs when a company, often led by its promoters, decides to exit the public market. Reasons can include gaining full control, reducing regulatory compliance costs, or undergoing a major restructuring away from public scrutiny. Remember Vedanta Limited's attempt to delist from Indian exchanges in 2020? This was a voluntary move aimed at operating privately. On the other hand, compulsory delisting is a punitive measure. It happens when companies fail to meet regulatory requirements, violate listing agreements, or engage in fraudulent activities. This can severely impact shareholders, as their shares may become illiquid and difficult to trade. Sometimes, a delisted company gets a second chance through relisting. This is when a company, after being delisted, manages to meet all requirements and re-enters the stock exchange. A notable example is Reliance Power, which was delisted and later successfully relisted. Relisting offers companies an opportunity to rebuild trust, raise fresh capital, and regain market visibility, providing renewed hope for investors who held their shares through the delisting period. Finally, let's explore share swaps, a common and crucial mechanism during mergers and acquisitions, M&A. Instead of receiving cash, shareholders of the acquired company receive shares of the acquiring company. It's essentially an exchange of ownership, allowing for a seamless transition and continuity. The core of a share swap is the swap ratio, which determines how many shares of the acquiring company shareholders will receive for each share they hold in the target company. This method is often preferred because it's tax efficient for both companies and shareholders, preserves cash for the acquiring entity, and aligns the interests of shareholders in the newly combined entity. A prime example is the landmark merger of HDFC Ltd with HDFC Bank, where HDFC shareholders received HDFC Bank shares based on a predefined swap ratio. This created a much larger, more robust financial institution, offering shareholders a stake in the combined entity's future growth. For you, the astute investor, understanding these corporate actions is not just academic, it's absolutely vital. A buyback can signal management's confidence and potentially boost your returns. A delisting, especially a compulsory one, could severely limit your ability to sell shares. A share swap can completely alter your investment exposure, shifting you from one company to another. Always track these announcements diligently. Consider how they align with your personal investment goals, risk tolerance, and long-term strategy. These aren't just headlines, they are powerful indicators that can significantly impact your portfolio's performance. Now that you've gained valuable insights into buybacks, delisting, and share swaps, it's time to put this knowledge into practice. Don't just passively observe the market, Actively analyze corporate announcements. Subscribe to financial news, follow company disclosures, and always ask, how does this corporate action impact my investment? Share this knowledge with fellow investors, and let's build a community of informed decision makers. Your proactive approach today will pave the way for smarter, more confident investing tomorrow.